This chart for Seshaasai Technologies shows a textbook rounding bottom, indicating steady accumulation. This aligns with Q1 2027, where profit after tax surged 63.8%. But this masks a contradiction. While the bottom line exploded, top-line revenue grew only 13.3%. Operating efficiency didn't drive that profit either. Gross margins actually contracted by 527 basis points sequentially. We have heavy top-line friction paired with a massive bottom-line expansion. This divergence is the result of deliberate capital restructuring. To understand the market's enthusiasm, we must look past headline earnings and see how targeted debt elimination shields the company from serious macroeconomic headwinds. The global supply chain operates on tight margins. Disruption in ocean freight or material sourcing immediately hits the cost of goods sold. That reality directly impacts Seshaasai. As a hardware-driven manufacturer, their production floors rely on steady, predictable input costs to maintain profitability. This chart breaks down recent performance. While revenue reached a healthy 3.76 billion rupees year over year, it fell 6.9% from Q4. The real friction is operating efficiency. Over 3 quarters, gross margins contracted to 41.7%. Management explicitly ties this margin squeeze to elevated raw material prices and currency depreciation against the rupee. Those base material costs are further compounded by elevated logistics expenses, specifically stemming from the ongoing conflict in West Asia. The core hardware manufacturing business is operating under severe margin compression. The recent 63.8% surge in net profit absolutely did not come from operational efficiency. Beyond supply chain friction, the company has historically carried a high degree of client concentration risk within the legacy banking and financial services sector. In fiscal year 2024, their top 10 legacy clients generated 69% of total revenue. Management has spent the last 3 years engineering a softer reliance on those core accounts. This step chart tracks that progress. By Q1 of 2027, top 10 client concentration dropped to 56%. They achieved this dilution without shedding banking clients. Instead, they aggressively expanded into an adjacent market, IoT and RFID tagging. This sector focuses on embedding physical objects with digital signatures, allowing for real-time tracking and automated inventory management at a massive scale. We can see this applied directly in the retail sector, where their hardware enables rapid, contactless inventory audits. The financial impact of this pivot is clear in the revenue mix. The non-BFSI segment has nearly doubled its share, growing from 13% to 25% of total revenue. That momentum is continuing. In the first quarter of 2027 alone, they onboarded 13 new enterprise accounts across various industries. Despite acute pressure on manufacturing margins, the company is executing a pivot to de-risk its client base and build a resilient, diverse revenue stream. We still have an unanswered contradiction. If margins are shrinking and the new IoT business is still in its ramp-up phase, how did they deliver a 63%? Management manufactured software-like profit growth out of a hardware balance sheet simply by cleaning up their debt. The technical recovery we observed makes sense mapped against these internal shifts. The company has functionally eliminated the structural drag of high-interest debt from its capital structure. Simultaneously, they mitigated systemic risk by establishing a solid foothold in the expanding IoT market. However, the massive earnings beat generated by that debt payoff is a one-time event. The market will soon fully price that deleveraging into the stock. With the debt gone, future bottom-line growth relies strictly on the physical reality of the business. Management must now work to defend that 41% gross margin against an increasingly volatile and unpredictable global supply chain. This